Hi, Jason Kohut with Signet Financial Management of Southwest Florida. I wanted to do a quick video on a topic that has been in the headlines recently. Many economists and analysts are talking about the state of the yield curve and the potential inversion and why it's important to take notice. So what exactly is the yield curve? Why has it been in the headlines so much recently? And as investors, should we be concerned? Well, the short answer is yes and no. So let's take a look. The yield curve is basically the difference between interest rates on short-term United States government bonds, say like the 2-year Treasury note, and long-term government bonds, like the 10-year Treasury note. Typically, when an economy seems in good health, the rate on longer-term bonds will be higher than shorter-term ones. Now, the extra interest is to compensate in part for the risk that strong economic growth could set off a broad rise in prices, also known as inflation. Lastly, though, long-term bond yields have been stubbornly slow to rise, which suggests traders are concerned about long-term growth, even as the economy shows plenty of vitality. At the same time, the Federal Reserve has been raising short-term rates, so the yield curve has actually been flattening. In other words, the gap between short-term interest rates and long-term interest rates is shrinking. The gap between the 10-year Treasury note and the 2-year Treasury note is roughly about 34 basis points. Now, it was last seen at these levels in 2007 when the United States economy was heading into what was arguably the worst recession in almost 80 years. Now, as scary as a reference to the financial crisis sounds, flattening alone does not mean that the United States is doomed to slip into another recession. But if it keeps moving this direction, eventually longer-term rates will fall below short-term rates. Now, when that actually happens, the yield curve has officially inverted. New York Fed John Williams indicated from his perspective, an inversion is seen as a powerful signal of a recession. And that's what everyone now is watching for. As investors, what does this mean and what are we to do? There has been, in fact, periods with a relatively flat yield curve that have lasted years before a recession actually occurred. Now, most notably, this happened into the mid to late 1990s. Now, stock investors will have plenty of time to adjust their portfolios before the worst of the damage is done. Now, contrary to what many people think, inverted yield curves don't always sound the alarm to sell. In fact, looking at the past 5 recessions, the S&P 500 didn't peak for more than 19 months on average after the yield curve actually inverted, along the way adding more than 22% on average at the peak. Although the potential for inversion in the yield curve does pose risks, it's not a time to panic. Rather, it's a time to review your portfolio, adjust your risk, and prepare for a potential change in the overall investing climate. At Signet Financial Management of Southwest Florida, we specialize in analyzing risk in portfolios and making the appropriate adjustments so you can be positioned to take advantage of the next market cycle. For no obligation consultation and risk analysis, click the link below to schedule your review or simply give us a phone call. Again, this is Jason Kohut with Signet Financial Management of Southwest Florida.